Welcome to Volatility Trading Strategies. So hopefully you had a chance to check out part 1 of this video series. If you haven't seen it yet, I'm going to put up a link here. I've always wanted to do that, by the way, watching YouTube videos. Now I have my own channel, I can actually do that. So I'm going to put up a link here, and you can either watch it now or you can just watch it later. They're really not in any particular order. But in that first video series, we went through the first 10. We went through streaks and rankings, talking about the longest bull markets in history, the biggest Vix spikes ever. And then we got into the markets and had a look at what I think is shaping up to be quite a retirement crisis for anybody in my age group or younger. So as much as my parents' generation likes to complain about the economy, I think my generation might have it even worse. And the one after me, perhaps even worse than that, which is scary. But I made a case in that video for why I think at least in the next decade or so, stocks and bonds may be in for a tough go. So what we need to do is we need to find conservative, safe, but profitable trading strategies to fill in that gap in people's portfolios. But right now we're going to get into the next 10 of the 20 market analytics. Okay, so we'll start with the broad economy and of course the US real GDP. This is sort of the big number for the broad look at how an economy is performing. So you can see the red line here in this chart is the long-term average of 3.2%. This goes all the way back to 1948. And recently, of course, since the year 2000, the year 2000 is going to be a pivotal point for a lot of these charts. But you can see right now we're at 1.7. We were even lower. This has basically been happening since the year 2000. There was only a very minor period there where we went above the long-term average, but we've been below it for basically 16 years. So obviously this is not a blame Obama or blame Bush problem. Obama took office right here. So, obviously Obama has fallen short of a lot of the promises and, I'm not so sure that he lived quite up to the hype of 2008 with the Yes We Can and all that. But I don't want to come down too hard on the Obama administration because really they inherited quite a substantial crisis. I mean, biggest crisis in 80 years. I think given how severe it was, the U.S. shedding over 700,000 jobs per month when he was inaugurated president, I think I can forgive him for a lot of the very low GDP and the underperformance in the last 8 years. I certainly was not expecting it to be any better than 1.7. I don't know why there's this narrative that it should be at 4. You hear people like Trump talk about how it should be 4%. I don't know how that's even possible coming out of such a massive crisis. But, I don't think he's saying that from an economics perspective. It's just politician Trump. I think he's probably smart enough to know that, obviously his business acronym and all that, he knows that 4% is not possible. But moving on, let's go to the unemployment rate. Again, a number that it looks pretty good, actually. Here's the long-term average at 5.8, and we are currently at 4.9. So pretty significantly below the long-term average. Now, this chart on its own might give you the impression that there's no problems in the job market. Everything's fine. But actually, there's a number that you want to keep an eye on, and that's the labor force participation rate. So we definitely want to draw attention to this because it is a more long-term structural problem, right? The unemployment rate at 4.9, that's fantastic, but that's sort of a short-term right now thing. But what we really want to do is keep an eye on this dropping consistently since the year 2000. There's that number again, labor force participation rate. Now, the long-term average is 63, and we are just one tick below that at 62.9. So there is a way to say, hey, we're still basically on the average. However, it's pretty obvious that we are sliding pretty substantially since the year 2000. Both of those crises, 2000 and 2008, really hit the economy hard, and it hit the job market hard, and we have not recovered. Basically, we're facing that problem. We're also facing a problem where technology is replacing jobs far faster than we can find new industries to replace them. We have a structural problem, and this is something that most of the developed countries are facing. The world is facing that we have a structural unemployment problem where, honestly, technology is just putting a lot of people out of business. In certain places where it used to take an entire sales force, now 2 people and an internet connection can basically do the same marketing. In the past, when you had manufacturing, you had thousands of manufacturing jobs, pretty reasonably paying manufacturing jobs, all replaced by robotics now. You've got, engineering firms that used to have a big staff. Now you can, with a computer AutoCAD program, you get 5 guys and 5 people, women as well, sorry about that, in the same room. You can build a building with that. You can design the building. So we have a serious problem here. Now, I split it up into men and women just because I wanted to show the stark difference in that and basically highlight why we rose in the first place. Here's men, steadily dropping. Now, this doesn't mean that men are leaving the workforce necessarily. It just means that they're a lower percentage of the workforce. But here's women. Now, obviously, this happened because of the feminist movement, which was fantastic, and also the civil rights movement, which unfortunately I didn't have a chart for. I'll try to find one and put it here for minorities, but it's the same thing. The feminist movement and the civil rights movement were obviously a fantastic thing for just civil rights and, equality for all and everybody being treated equal in the labor force. All of those things are fantastic for the standard of living and the general, happiness factor in the country. But it's also a very good thing for GDP. Now, one of the best ways to boost a country's GDP, one of the fastest ways, most efficient ways, is to empower women and minorities. This has been true both in the United States, it's true in every example around the world. Empowering women and minorities is a fantastic boon for your GDP. So you can see the very prosperous years when that was all happening, but it has since dropped off. So we have to face this structural problem head on. Now, I know both Hillary Clinton and Donald Trump, they both have plans for infrastructure rollouts. So that should create some jobs, and hopefully that can sort of plug some of these holes. But it's got to go further than that, because that's just fiscal spending. What really needs to happen, I think, and this is just my opinion, but hopefully both of the candidates are really embracing the anthropogenic global warming, because I think what needs to happen is, just like in the past, the U.S. needs to lead the world in a new frontier. It's not good enough to just spend money on infrastructure and plug some holes and create some short-term jobs. You have to create an entirely new industry, and I think that's a great place to start. So, green energy, clean energy. If the U.S. were to lead the world in that, there would be so much opportunity, so many jobs created, spin-off technologies that can go in all different directions. We've seen this before, and that's really what needs to happen. This is a structural problem. This is not blame Obama. Obama's just here. This is not blame Bush. Bush is just there. This is a long-term structural problem that has been building up and for a long time. And if not for the great feminist movement and the civil rights movement, it would have been an even more long-term problem. But hopefully both candidates are on board with this, because that's really what needs to happen. So we'll move on to Treasury yields. Again, a very depressing chart to look at if you're an investor in today's market, because you know that there's an inverse relationship between bond fund returns and interest rates. So in the last 35 years, and this going back to 1980 would be all the way up here, going from 15% to below 2%, that's why we've been on a 36-year bull market run in the bond market. But it's coming to an end, and I'm not saying that with my crystal ball. I'm not predicting anything. I'm saying, mathematically speaking, in order to mirror the last 36 years, interest rates would have to dip into very deep negative territory. We're talking minus 12, minus 14%. You wouldn't even get close to that, obviously, because the money under the mattress option would be looking very attractive at that point. So we're never going to be able to duplicate this again. The bond run is over, and we have to deal with that. We as investors have to deal with that. We have to figure out a way to make money and to grow our retirement funds without relying on the bond market, because bonds are not going to be there for people to pad their savings account. I'm not a doomsday person, but we do have to face realities, and I'm just trying to bring them to light. So here's the inflation rate, again, very similar. 1980 was extremely high. Then it's been a steady, slow drag downward. And in the past 5 or 6 years, the Federal Reserve has a target number of over 2%. And they have been failing at achieving that. You can see we're at 1.06 the last 12 months. So despite all the quantitative easing, despite all the aggressive monetary policy, they've still fallen short of their target 2%. And honestly, they're definitely running out of ammunition. I don't know what else they're going to do in the future, but they're running out of bullets here. So could be a problem. I'll update these obviously all the time, so please come back to the website often and get the new results. Finally, we'll check out real rates because that's really what matters. If you've got high interest rates, that's only going to make you money if the interest rates are higher than the inflation rate, of course. So what you really want to look at is the real rates. And very prosperous from the 1980 period all the way again to that big number 2000. And then everything starts to slide from there. So real rates are definitely down as well. And this is a problem. This is why people feel they not only are not making as much money and flat wage growth and all those things, but they feel that as well. And this is why, because inflation is actually right basically in line with interest rates, and it shouldn't be that way. So that is the broad market, broad economy. Let's get into some volatility specific analytics because these are what affect my trading the most, specifically our volatility trading. But even if you don't trade these volatility products, I would still encourage you to check the volatility analytics because if you're getting your signals off the S&P 500 for trading the S&P 500, for example, that's all backward looking. So it doesn't matter if you're using moving averages or Bollinger Bands, maybe RSI indicators or MACD. Those are all fine indicators, but they are backward looking. So the volatility market has a tendency to be forward looking because it takes into account implied volatility. And of course, those numbers aren't picked out of random. They're actually people's money making future bets. So the volatility analytics are important for everybody, not just volatility traders. So let's get into the first one, the term structure contango. This is a very important one. And I should mention that if these concepts are unfamiliar to you, maybe you're not a volatility trader, that's okay. Just use this period as a sort of a jumping off point for your own research. And if you ever have any questions, feel free to email me. You can contact me, and you don't have to be a paying subscriber or a client of mine to get my advice. So if you want to email me a question, I'd be more than happy to help you. If I need to elaborate a little bit more, maybe I'll even make a video and send it to you through email. But yeah, feel free to ask me anything you like. So this VIX Futures Contango chart, this is important because we basically want to know when certain of these volatility products, the XIV for example, has a headwind or a tailwind. And this chart will allow us to determine that. Now obviously this is just one very tiny aspect in a whole spectrum of signals that people should be tracking, but this is one of them. So along the same lines, we've got the VIX term structure roll yield. This is essentially what we're trying to arbitrage when we're trading these products. And again, we've got the mean and we've got a 10th percentile where anything below that reflects, elevated fear in the markets. Now, this is a chart that I'll spend a little bit of time talking about. So I kind of have a reputation of just speaking the truth and, maybe saying things that other people won't. And in a year that I'm up 60% in my volatility trading, that's a big year, fantastic year. You'd think I'd just be talking about, how great I am. But the truth is, and I'm just going to hit you with the honest truth, 2016 has been a very, very easy year for trading volatility products. So there's really no reward there. There's no, prize for having big returns this year. Everybody, even if, and honestly, the more aggressive you traded, the better your returns would have been this year. So the people who ignore their safety, people who don't pay attention to risk management and capital preservation, some of those people might even be up 90 or 100% this year. It's been a very easy year. You can see the roll yield. This is the highest year on record. So 2012 and 2016 for volatility traders, specifically XIV and VXX, these are slam dunk years. I mean, it's actually pretty difficult not to be performing well this year. What you really want to do if you want to analyze performance is you want to take into account 2015 for sure, because that was the hardest year for trading. Not only for volatility, but also the stock market was flat. Bonds didn't go anywhere. You've got all these, funds, hedge funds and financial advisors. Nobody really made any money in 2015. And volatility traders were the same. These aggressive traders who were killing it in 2016, you look at their results for 2015, and chances are pretty good. They're a lot lower. You might see flat returns. You might see maybe +5 or 10. In some cases, you might see -10. But you want to take into account 2013 all the way to 2016. 2016 on its own, I gotta say, despite the fact that I'm happy that I'm up 60%, this year really doesn't mean that much. You want to take an average of the 4 years, and that's going to be a determination. And anything before 2013 doesn't matter at all. You can just throw that out and totally ignore it. The volume on these products from 2010 to 2013 was not nearly high enough to gauge any type of results on these. So, and of course, before 2010, the product didn't exist. So if you ever see results going back further than that, you know there's a little bit of padding the returns going on there, because before 2013 is totally meaningless. But remember to take a 4-year average. 2016, as you can see here, very, very high roll yield. It's actually been a pretty easy year. And the less you knew, the better off you did. It's kind of one of those strange years where, you know, the inexperienced traders really hit a home run this year. So anyway, moving on. Here's another metric that I use very often in my own trading. It's the VIX to the VXV. The VIX index being a 30-day forward-looking volatility indicator, and the VXV being a 90-day. So just the ratio between the two of these can tell us a lot based, you know, where these products might be heading. You know, the basic perception of short-term to long-term volatility in the market. Very important indicator. VVIX, again, I check this thing all the time. It's, you know, it's one of, I don't know, one of 10 or 15 indicators that I really focus in on. And again, I've got the means and the 90th percentile for you. So you'll be able to determine your own levels of where you like to trade. And the Vix Standard Deviation is another chart that I'll give you. It's a 5-day Vix Standard Deviation. It also shows a lot. You know, if the VIX is moving around a lot, it's probably not a great time to be trading. If the VIX is very stable, that might be a tailwind for the XIV. So that's it for the indicators. Now, of course, like I said in the first part of this video, I want this to be interactive. So out of all of these 20 charts and 20 analytics, I want you guys, my viewers, my members, subscribers, to give me ideas of charts that you think I may have missed or charts that you think I should add to it. And maybe over time, over the next couple of years, we can turn the 20 into the 30 and the 35. We can get a real comprehensive look at the market. So with your help, with your comments in the comment section, we can build this thing pretty good. So I will do the work. I will update the charts. You just give me the ideas. So again, just a little bit of business. If you're ready to subscribe, the great thing about subscription to my website is you always get a free 2-week trial, so you can try everything risk-free. Here's the Volatility Strategy. This one trades stocks, bonds, and gold. They both do very well on their own, but of course I would always encourage diversification. So the Total Portfolio Solution incorporates both of them into the same fund. And you can try any one of these for 2 weeks for free. So, you know, obviously no pressure. I don't do any hard sell. I don't twist anybody's arm. Do your own due diligence, but you know, if you're ready, I'm here, and you can always ask me any questions you like. And lastly, obviously, just really quick, please subscribe to my YouTube channel, because it's just started, and I really feel like it's going to be a fun thing for me, and I really want to help people out. So give me some ideas, give me some suggestions on future videos, and I'll go ahead and put them together for you. So thanks for watching, and take care.